Okay, welcome back. Thank you very much for coming back. The second presentation in this workshop is on quality infrastructure and natural disaster resiliency. This is an empirical work on a group of countries from Asia and Pacific. So let me share my screen. Is it visible now? Is it clear now? Can you see the screen? Yes? Okay. So quality infrastructure and natural disaster resiliency in Asia and Pacific is the title of this, just a moment, is the title of this presentation. And this is the paper, this is a reference of this work. It's published in Economic Analysis and Policy, Quality Infrastructure and Natural Disaster Resiliency. That in this paper, we assess the impact of quality infrastructure, development, and corruption on damages caused by a natural disaster using the panel data of 14 Asian Pacific countries. So what is quality infrastructure? What is quality infrastructure? So quality infrastructure, in the simplest way to answer, is an infrastructure which is strong enough. For example, a bridge which is strong enough, an airport which is strong enough, a road which is strong enough. But this is not the complete answer. This is just an engineering answer, not an economic answer. So if someone asks an economist that what is a quality infrastructure, the correct way to answer it is that quality infrastructure is an infrastructure that, first of all, it is physically strong and it is physically high quality. It has high durability. It can, the life of it can be enough. And secondly, it can create economic value for the region. For example, if we have a bridge, if we have a highway, if we have an airport, which is very strong, but no one uses it because of lack of demand in the region, because of low demand for using that infrastructure, because the region is not developed enough, the GDP per capita is low to, the GDP per capita is low to, for example, have car ownership or to take flights using that airport. So this means that that infrastructure, or such infrastructure which was physically strong, but it couldn't create economic output, economic value. Therefore, we don't call this infrastructure quality infrastructure. So this is the economic answer of a quality infrastructure. Then this is the outline of my presentation: introduction and background, literature review, financial innovations in disaster risk reduction, theoretical model, empirical result, and conclusion. First, the introduction. Increasing disaster resilience is key to mitigate the impact of disaster. Natural disasters have become more costly in the recent few years. Asia and Pacific in particular was the region that was the most affected, with 44% of all disaster events, 58% of the total death, 8% of the total death, and 70% of the total people affected in 2017. Therefore, it is important to increase the resiliency to natural disaster through prevention and mitigation. Few authors wrote about the impact of mitigation measures on disaster resilience. So this study aims at quantifying the importance of development of quality infrastructure in disaster resiliency. So first, we have done a comprehensive review of the literature. In the literature, most of the studies focus on how to finance the risk and indemnify the damage caused by disaster rather than on preventing measures. So majority of the studies in the literature, they are talking that if a disaster happened, if a damage happened, how to construct it. If a damage happened, how to indemnify it, how to finance the risk. A review of the academic literature on the topic has proved that most of the studies focus on how to finance the risk and indemnify the damages caused by the earthquake rather than on preventive measures, such as Kummin and Mahul, McKenney et al., Koshi et al., Paleari 2019. As Metzler 2015 highlighted, one of the key factors for implementing DRR, disaster risk reduction, is finance. It is a lagging area of DRR, as most financial assistance is still provided by donors, governments, and multilateral development banks in a context of a developing country. So we identified the determinants of society's resilience throughout the literature review. First of all, private insurance is very important. Private insurance is shown to mitigate the impact of disaster and accelerate the recovery. So because of that, when we want to look at one case, one country, and we want to understand whether this country has enough resiliency, insurance penetration is very important. Extreme poverty is proved to worsen the effect of natural disaster, and many studies highlighted the level of development decreased the risk. When the level of development decreased, the risk, also decreases the income. Thirdly, institutional quality and the level of corruptions are also matter. So when the institutional quality is low, when the level of corruption is high, then the disaster risk resiliency is low, according to several studies. Few authors mentioned that quality infrastructure and preventing measures has a positive effect on disaster resilience. However, none of them quantified such effect. Next, role of governments in developing and financing quality infrastructure. Quality infrastructure investment is measured by assessing how much each respective infrastructure helped develop the region, as I've mentioned in the beginning of this presentation. One possible way would be using additional tax revenue generated by a spillover effect after the construction of the infrastructure. Because when in a region which didn't have infrastructure, when an infrastructure established, for example, a road is established, a highway is established in that region, then because of the establishment of that infrastructure, more output will be generated from that region. More businesses will grow in the surrounding of the road, in the surrounding of the highway. So this is called a spillover effect of infrastructure. Then the local governments, because of this spillover effect, can collect more taxes because the sales of the shops will increase. Price of property will increase. Then local governments can collect more property tax, more sales tax, more income tax, more value-added tax. Then, if governments inject or return a portion of this increased tax revenue, which is because of the spillover effect of infrastructure to the private sector, the rate of return of the infrastructural project would increase. Another scheme is what I have mentioned in my previous lecture, is establishment of credit guarantee scheme to manage the risk of investment. So these two innovations, credit guarantee scheme and spillover effect, spillover tax, if we run the projects simultaneously, if we run these two policies simultaneously, then at the same time, simultaneously, rate of return of the project will increase and the risk would be reduced. So this means that these kinds of innovations, financial innovations, are very helpful. Next financial innovations for disaster risk reduction. Currently, majority of the DRR, disaster risk reduction activities, are running by the governments, and majority of these projects are running by the government, and private sector has very low involvement in DRR project. Despite being one of the major financing channels for DRR, using public funds poses several problems. Public funding and overly generous compensation scheme may trigger moral hazard and discourage individuals to subscribe to private insurance schemes. A study by Koski, Michel Kerjan, and Rashki, 2018, provided empirical evidence of such effect in the United States. The authors found that receiving individual assistance grant decreased the average quantity of insurance purchase in the following year. Therefore, it is crucial for the private sector to participate in financing disaster. Next is index-based insurance, is one of the new instruments. Index-based or parametric insurance is one of the new instruments that could be helpful in mitigating the impact of natural disaster. Instead of insuring against the loss itself, index-based insurance proposed to insure a certain asset against the event that caused loss. In particular, weather derivatives are an example of parametric insurance that protect buyers against the impact of adverse weather condition on their business property. Valuing such insurance can be based on previous measures of temperature change or meteorological data. Another type of instrument is cat bond or catastrophe bond, is another innovative financial instrument. Another innovative financial instrument that emerged in the recent year are catastrophe risk bond or cat bond. Cat bond is an instrument whereby disaster risks are securitized in the financial market. The transaction starts with the formation of a single-purpose reinsurer or SPR. The SPR issues bonds to investors and investors proceed in safe and short-term securities. And a special option is embedded in the cat bonds that is triggered by the defined event. On the occurrence of this event, proceeds are released to help the insurer pay the claim. In return for the option, the insurer pays a premium to the investors. Investors received an above market return when the event doesn't occur, but lost interest or part of the principal otherwise. In other words, cat bond is a financial instrument that allows the insurer's extreme risk to be passed to investors, willing to risk losing all other investment in the case of a natural catastrophe. Another thing, as I've mentioned, index-based insurance and cat bond that I've mentioned, these two, although these are new and these are innovation, but both of them are expensive product. Despite their advantage, both weather derivative and cat bond remained relatively expensive financial instruments, and as such, are not affordable for low-income households and farmers in developing countries. One alternative has emerged in the recent year in the form of microinsurance. Microinsurance is defined by Churchill, 2006, as the protection of low-income people against a specific peril in exchange for regular premium. Then the regular premium payments proportionate to the likelihood and the cost of risk involved would be covered. Perils refer to health problems, death, or property damage that have a financial impact on individual. Just like any commercial insurance, it can be a tool for protecting buyers from the adverse effect of disasters. Two types of microinsurance can be distinguished: standalone microinsurance, usually for crop risk, and bundled insurance, which is coupled with loans and saving. As I've mentioned, microinsurance are more affordable tool, especially for lower income countries. Bundled insurance contribute to risk reduction through the reduction of the financial burden, while standalone microinsurance for crop risk create incentive for risk reduction. One example of bundled insurance for credit and saving can be found in Bangladesh through the insurance of livestock by Proshika. The Participatory Livestock Compensation Fund, or PLCF, was introduced in 1990 and covered loss of livestock by sudden death. In 1991, the scheme was extended to include the Natural Disaster Management Program, and compulsory group-based insurance was adopted in 1997. These insurance funds cover 10% of the whole population of the country in property insurance. An example of a standalone microinsurance was introduced in India in the form of basics insurance. It covered non-integrated farmers in Andhra Pradesh against the risk of insufficient rainfall. The scheme increased its penetration from only 230 farmers to 10,000 farmers only a few years later. So this is what I have mentioned earlier, that currently for many infrastructural projects, their only return is the user charges or the toll. For example, for the highway, only the toll that the private sector is receiving. So because of that, because it is constant and because it is low, therefore that infrastructural project is not very interesting for the private sector. This is what we have introduced, the spillover effect, because due to establishment of this infrastructure, the regional output, the GDP of the region would increase. Therefore, the local governments can collect more taxes from the local, more income taxes, more property taxes, more sales tax, more value-added taxes are collected due to establishment of this infrastructure. Then, if injecting a portion of that spillover tax to the infrastructural project, the rate of return of the project would be increased. And secondly is credit guarantee schemes that I have introduced, that governments, instead of developing the project by themselves, government bring the capital for the Green Credit Guarantee Corporations. Then the Green Credit Guarantee Corporation provide guarantee to lending institution, and lending institution give loan to the infrastructure projects. The theoretical model of this paper, so we have the production function. The production is a function of three inputs: labor inputs, private capital, and government capital, such as infrastructure, port, road, and disaster prevention activities. Good infrastructure produce larger GDP. For example, good port can increase export, which in turn increase the GDP. As it is clear here, this shows the differences. Impact of disaster to economy, DS, is shown here. This impact is negative. These production inputs have positive impact on GDP. However, disaster risk has negative impact on GDP, as it is clear here. This will lead to, because of the occurrence of disaster, if the economy damaged, then the tax revenue of the government would decline. And on the other hand, government spending will increase because governments then needs to pay for the recovery. This is the first case, the case that the governments didn't spend enough for prevention measures. The total amount of tax reduction for the disaster is expressed as equation 6. This is showing the reduction in the GDP due to the disaster. This is the tax rate, and this is the amount of disaster. So then this shows the reduction in the tax revenue of the government due to the disaster. And on the other hand, government expenditure will increase because governments needs to do the post-disaster activities, since the government didn't spend enough before this disaster. The second case is a case that government had proper disaster prevention measures. Then for this case also, the production is a function of labor, capital, and KG. So KG, it means government had, because it is a star, government had adequate disaster prevention. And then, as it is clear here, this shows that how this disaster is affecting the output. Equation 10 is showing the case where the government provided enough disaster prevention, while equation 4 is showing the case that government didn't provide enough prevention measures. And as it is clear here, decrease in the GDP due to this disaster in the case of non-prevention measure is much larger when comparing to the second case. Therefore, for the case that government had enough prevention measures, the tax reduction with the case of disaster is much smaller than the case of without adequate disaster prevention. Then the net government spending with proper disaster prevention becomes smaller. So as we see, then in the post-disaster, government needs to spend smaller amount because earlier government spent it, and the reduction in the tax is much lower. Then this is an issue. For the empirical part, we have used the data of 12 Asia-Pacific countries throughout 2008 and throughout 2008, and then the left-hand side variable or the dependent variable is damage. Total estimated damage in $1,000 US. We got it from EMDAT database. Then the explanatory variables are these: trade and transport infrastructure index. So this is from the World Bank. It shows the quality infrastructure. Quality of port infrastructure is a variable that we got it from World Bank database. Insurance penetration, the review of the literature shows that insurance penetration is important in order to increase the resiliency of our economies toward disaster. This is showing the financial, this is a kind of financial variables. Poverty is matter according to the review of the literature, according to our theoretical work. When the poverty is higher, then the resiliency would be lower. So we have two variables, poverty gap and poverty headcount. And development variables, we have GDP per capita, PPP. Institutional quality is also matter. When there is more corruption, then there is expected that the resiliency is lower. So for the corruption, we have corruption as measured by the Corruption Perception Index from the Transparency International. So we have done the Pesaron residual cross-sectional dependence test, and then we have done the unit root test and the residual co-integration test. So the series are integrated. As you see here, 1, 2, 3, 4, 5, 6 variables in the Pedroni test reject the null hypothesis of no co-integration. And then we have done the co-integration test, rank, and so on. As you see here, the series are co-integrated. Therefore, since we have a VAR model, we need to do an error correction model. We have done the vector error correction model. And here, as it is clear here, the coefficient of port infrastructure is statistically significant, and it is negative. It means that when we have a higher quality infrastructure, then damage would be lower. And the trade and transport infrastructure also same. For poverty, as we see, it is higher. I mean, the coefficient is positive and it is statistically significant. It means in line with the review of the literature, when the poverty is increasing, then we should expect that the the resiliency reduce and the damage caused by the disaster also increase. The variance decomposition, as it is clear here, is showing the loading of each of the variables. Port is larger, and also the insurance penetration is large, and poverty headcount is large. These are comparing to others. And let me conclude this part. Microinsurance are more affordable tool for lower income country. In the literature, most of the studies focus on how to finance the risk and indemnify the damages rather than on preventive measures. Quality infrastructure development remained a lagging area in disaster risk reduction. Through a review of the relevant literature, 2 schemes for financing of infrastructure were introduced. Public-private partnership using the spillover effect and credit guarantee scheme. The empirical results show that infrastructure and poverty indicators have the largest impact on explaining the changes in damages caused by natural disaster in both short and long run. The empirical results from this research suggest that increasing the quality of infrastructure may have a larger impact on decreasing costs arising from natural disaster. Okay, thank you very much for your attention. Thank you for your attention. I hope that the second presentation was also clear and you could get the points.